Welcome to this explainer. Look, if you've been tracking the markets lately, you can already feel it in the air. The atmosphere has completely changed. We are right in the middle of a massive macroeconomic shift here in August 2026. We're seeing capital aggressively pivot away from a stalling tech sector and flood into entirely new alternative havens.
Let's jump right into this staggering number, $400 billion. And no, that's not a typo. That is the record-breaking absolute mountain of cash Warren Buffett's Berkshire Hathaway is currently hoarding on its balance sheet. When the Oracle of Omaha sidelines this much capital, it sends a very clear, very loud signal to everyone else about exactly what lies ahead. So here is our roadmap for understanding this historic pivot. We'll kick things off with a macro reality check, dive into the new market catalysts, explore the escape into alternative assets, uncover a hidden crisis in higher education, and then wrap it all up with the capital reallocation playbook. Let's get into it.
Section 1. The macro reality check. We really need to establish the economic baseline that is basically forcing institutional investors out of their usual comfort zones. And this graphic right here tells you exactly why Buffett is holding all that cash. Take a look at the Buffett indicator. Both the classic and the FactSet adjusted versions are absolutely flashing red. The classic indicator, which measures the Wilshire 5000 against US GDP, is sitting at a massive 230%. Even when you factor in overseas earnings with the adjusted model, we're still at 144%. Sitting well into the elevated and overvalued zones like this strongly suggest we are staring down the barrel of historically subpar returns for the US stock market going forward. Because right now the market is caught in a brutal tug-of-war. On one side, you have the heavy anchor of 4.7% 10-year Treasury yields, which makes those huge AI investment pledges incredibly hard to swallow as borrowing costs shoot up. But on the other side, you've got policy catalysts desperately trying to soothe that pressure. Things like coordinated US-Japan yen inventions and renewed diplomacy in Iran trying to keep a lid on inflation. Moving on to Section 2, the new market catalysts. With big tech stalling out under those heavy borrowing costs, let's see how this capital is finding entirely new arenas for growth. Take a look at the extreme estimate skew happening over on the AI frontier, specifically with SpaceX's big AI infrastructure bet. They are burning through a staggering $7.7 billion in capital spending against just $818 million in revenue. They're literally spending dollars to make dimes right now. They're building these massive data centers, but the immediate question for investors is whether that astronomical quarterly burn rate is actually going to translate into true AI dominance.
So, if investors are rotating out of those extreme tech valuations, where are they going? Enter the sprawling GLP-1 medical boom. This is rapidly becoming the medical equivalent of the AI gold rush. We're talking about capacity-constrained, high-demand markets with insane pricing power. What started out strictly as a foundation for weight loss and diabetes has completely exploded. We're now seeing these drugs target sleep apnea, fatty liver disease, heart disease, Parkinson's, even addiction. And when Medicare started covering GLP-1s for weight loss on July 1st for just a $50 copay, that was a massive regulatory catalyst that unlocked a colossal new demographic overnight. Breaking down how these drugs are actually delivered, we see Eli Lilly dominating the current standard of injectables with about 60% of the market. It's established, but it is capacity constrained. The next big frontier, though, is pills. Novo Nordisk has snagged an early 85% share here, and while sales are just ramping up, pills are expected to capture 25% of the total market by 2030. The key takeaway? This isn't just cannibalizing their injectable revenue, it's expanding the total addressable market.
And the sheer scale of this is undeniable. In our 2026 reality, Eli Lilly is looking at $31 billion in profit, ranking them 14th in the S&P 500. But it's the future projection that has capital absolutely flooding in. Morgan Stanley is projecting $190 billion in sales by 2035. To put that into perspective, that completely dwarfs historic pharmaceutical peaks, leaving the $40 billion Pfizer COVID vaccine and the $50 billion Merck Keytruda entirely in the dust.
Which brings us to Section 3, the alternative asset escape. What's really fascinating here is how the super rich are driving a massive financialization of pop culture and entertainment.
Owning a sports franchise used to be this massive ego play, right? Just wealthy individuals funding passion projects. But in 2026, it has totally transformed into the smart play. We're seeing massive institutional syndicates stepping in. Just look at venture capitalist Vinod Khosala's recent $9.6 billion acquisition of the Seattle Seahawks. It's no longer a vanity project. It is a highly structured, high-yield, non-correlated defensive play. This heat map perfectly reveals how that capital is being deployed across different layers of sports. At the core, you have the NFL, NBA, and MLB. Multi-billion-dollar entry points with extreme scarcity. Move one layer out to the expansion zone, and you've got the English Premier League and Formula One seeing immense U.S. investor interest. Then, out on the frontier, you have the explosive growth plays. The WNBA, NWSL, and professional pickleball, which offer lower barriers to entry but incredible year-over-year growth.
And right alongside live sports, Hollywood's $10 billion comeback is providing another incredible escape hatch for capital. But the real story for investors isn't just ticket sales, it is the insane, high-margin peripheral merchandise. We are talking robust consumer resilience where people are happily dropping $30 to $35 on a popcorn bucket and $25 for an action tumbler. Turns out, spending $35 on popcorn is terrible for your wallet, but absolutely incredible for institutional investors.
Now for Section 4, Higher Education's Silent Crisis. Because while everyone is watching capital chase yield in medicine and sports, a silent canary in the coal mine is flashing a major warning sign over here.
This leaky funnel graphic perfectly illustrates the hidden structural risk unfolding right now. College leaders are quietly raiding restricted philanthropic endowments. Instead of using those funds for what they were intended for, they're siphoning off this generational wealth just to cover their day-to-day operating bills and plug structural deficits.
And the data is super alarming. Nearly 200 private colleges borrowed from restricted endowments in 2025. That's a huge jump from just 131 colleges back in 2021. For institutional investors, this is a glaring leading indicator of mass financial distress and incoming consolidation for the mid-tier private university sector.
Finally, Section 5, the Capital Reallocation Playbook. Let's pull all these threads together and map out exactly how institutional strategy is navigating this near future.
This matrix perfectly synthesizes everything we've talked about today. The smart money is migrating away from the high volatility and vulnerability of legacy tech and the cash-burning AI frontier. Instead, they are running towards structural growth and safety, locking in non-correlated yield in alternative assets like sports, and chasing the undeniable, capacity-constrained earnings power of the GLP-1 healthcare engine.
To make this totally actionable for you, here is your immediate watch list for the week ahead. On Tuesday, August 4th, we've got the AI litmus test with earnings from SpaceX, Palantir, and AMD. Keep a close eye on their CapEx guidance. Wednesday brings the GLP-1 reality check with Eli Lilly's earnings. Watch for margin expansion and updates on that pill pipeline. And then Friday, the massive macro pivot, the July U.S. jobs report, which is really going to test the Fed's stance on interest rates.
Look, the whole board is resetting right in front of us. We're watching historic cash hoarding by legends like Buffett, a massive pivot away from AI capital burn, and a full sprint toward the structural growth of GLP-1s and sports franchises. As this macro environment completely rewires the market's engines, you have to ask yourself, how are you adapting to this August 2026 reality? When the smart money moves, where is your capital pivoting next? Thanks for joining me for this explainer, and stay sharp out there.